Hi everyone, Tom here from Hedge Fund Tips. Wanted to walk through some of the week's highlights and start with this article we put out on Thursday, which is among our weekly sentiment series. And this week we entitled it The Three Tenors Stock Market and Sentiment Survey Results. The basis of the article is the Three Tenors sang O Sole Mio, which was composed by Eduardo de Capua in Odessa during April 1898. And the theme is that good days are here after a long storm. And I liken the trio making this beautiful music, operatic trio, to the current day regional central bank heads, Jerome Powell, Christine Lagarde, and Haruhiko Kuroda from Bank of Japan. And the basis is from 2009 to 2017, you had these three central banks working in concert, making beautiful music, adding liquidity to the markets to overcome all the debt that had been written down, to replace the contraction in money supply as those write-downs were taken over years. And about 2 years ago, they stopped. The Fed went on a tightening spree and began raising rates very, very quickly into what became slowing growth. And the ECB started decreasing the size of their balance sheet. And the Bank of Japan stayed in the market and stayed easy. But the problem was, when left on stage by itself, they could no longer hold a note on their own. So in recent weeks, actually since September, starting in the summer, the Fed started to lower rates again. We've taken it down 75 basis points. But more importantly, going on behind the scenes, is they've increased the balance sheet and added over $200 billion of liquidity back into the market in the last 8-9 weeks. The ECB is back in the market, starting to buy $20 billion of assets a month to start. And the Bank of Japan has always been there. So basically, it's the first time in 2 years that they're all coming back together to add this liquidity back into the market, the same way they had been from 2009 to 2017 before they prematurely stopped. And what's unique about this situation is not only are they adding liquidity and bringing the discount rate down at which we value those forward earnings streams, but we're doing that just as they were tightening into slowing growth. They're actually adding liquidity into rising growth. Earnings estimates for the U.S. are expected to be just shy of double digits for 2020. They've really held in there at about $179. We'll get into that in the next clip, but about $179.37 S&P earnings per share for 2020. And the last time we had that type of jump in earnings was going into from 2016 to 2017. Very similar. We had 3 consecutive negative quarters of earnings growth in 2016. And just as we're coming into we've just finished up 3 consecutive quarters of negative earnings growth in 2020. But estimates for 2017 were low double digits, about 10-11%. And you had a rise in the stock market starting to discount that in late 2016, right around now, in early to mid fourth quarter, the market started to discount the 2017 earnings stream. And in those 6 quarters from, basically it was 13, 14, 15 months from, call it late October, early November 2016 to January of 2018, the stock market appreciated S&P 500 appreciated mid 30%. And on a 10% earnings gain, you got multiple expansion, etc. And now we have a very similar situation. Expectations have been very low. You've got 3 quarters of negative earnings growth, but you have this forward earnings estimate near double digits. And you also have the interesting thing of recent yield curve inversion. And if you look at the last 3 times that the yield curve is inverted, you've had moves after the 210 inversion, which happened in August of this year. You've had on average mid 30% moves over the next 18 months to the peak of the market. So a lot of things are lining up. You've got the earnings growth. You've got the central banks cooperating all together. You've got the liquidity. You've got the inversion that usually leads to a period of very steep gains in a very short amount of time. So this, just we went into a couple of the balance sheets here. Here's the Fed balance sheet in the last couple of months. It's just a dramatic move, over $200 billion. Bank of Japan's been in the game. They've stayed in the game. And the ECB is now going to play catch up starting yesterday. So a lot of good things in place. We covered a little bit about sentiment just to get a sense of the short term. I just kind of gave you the longer term outlook for the next 6 to 18 months. Looks pretty promising with the earnings expectations. So sentiment this week came in surprisingly low. We're breaking out to new highs, and the bullish sentiment was only 33.98, down from last week a little bit. I'd expected this to be up closer to 40% this week. As you saw, the fear and greed index got up to a greed level of 75-80 is where you want to start to look at some caution. So it was a mixed read. The fear and greed was up there. The bullish percent was not, which implies there's a little more room to run in the short term. But I think the moral of the story here is you've got to be selective and playing in those sectors and those stocks that are just starting to get rotations and just starting to get money flows right now is where you want to play. And we talked about an article that we put out last month, about 4 weeks ago, looking at biotech. The earnings growth, the estimates had gone up meaningfully, close to 9%, and price at that point had been down 9.5%. And that's a movie that tends to play out. That divergence gets resolved to the upside. And if you look over here, that has been the case. So we've had this monster 10% plus rally in the last 4 weeks, and that looks like it has a lot of gas. The other sector that we pointed out in this article was the exploration and production subsector and their earnings. Basically, we have this sector trading down to 2009 crisis lows. And for all kinds of reasons, portfolio managers just hate everything about this sector. The narrative on the street is that it's never going to recover. We're going into renewables, and there's just such a surplus of production, and we have more than we'll ever need, and there will never be any Middle East supply disruptions, and there's really no security premium whatsoever into this. So I just decided to take a look, and I referenced in the article about Secretary Mnuchin at a press conference said when they were announcing the China deal a few weeks back, he said, the reporter asked him, the market's up on expectation of a China deal. Is there going to be a China deal? And he said, the market is always right. So I said, well, I wonder if the market's right. Is this subsector never going to recover? It's trading at great financial crisis, once in a generation lows that it hasn't seen, and it saw it again in 2016, and now it's back down here. So I took the top 30 weights of the sector that had comps in 2009, and I just went one by one, and I looked at the earnings power of each of these names, and sure enough, the market is somewhat right, okay, in that in the past 11 years, the earnings power has gone up by only 32.4%, which is anemic. I mean, that compounded annual growth rate is low single digits, and it's really pathetic. So in some sense, managers are right. These companies have not grown materially in this time period. On the flip side, you're trading at the exact same price, and yet the earnings power is up 32%. So that's unnatural, number one. Number two is the fact that For 2020, although we've had terrible earnings growth in 2019, in 2020, this sector is expected to lead the earnings growth going forward. So they're going to have the highest percentage. This has come down to about 25% earnings growth for 2020. So not only is the 32.4% growth from 2009 being not factored in, but the 25-30% for next year is not being factored in. And that's kind of like why we are looking at this as a contrary play. To have some exposure can give you a basket of outperformance, just as we had experienced here in the last 4 weeks in biotech, betting on that, which was down and out over the healthcare political noise, which we acknowledged when we wrote the article. So those are a couple things we covered in the Three Tenors article. So the AAI sentiment has some room to run. The fear and greed is up there. So, things that you've had that have run a lot, you may want to harvest a little bit of those gains. But the opportunity now is really coming into year end for most managers that have been offsides. Everyone was moving into bonds in August, and we made a strong argument to move into increased allocation to equities. And you can review all of our notes here. We've got Frank and Jerome agree, the best is yet to come. That was from October 10th, when bullish sentiment was only at 20%. And then on September 5th, this article here, we were calling for a melt up into year end. So you can take a look at that article. But now you've got managers still offside. So this chart here, this is the National Association of Active Investment Managers. They're still down at 65% going into year end, with the market making new highs. I think you're going to see a real panic as the market creeps higher. You may get a couple fake shakeouts just to get the late money that has just come back into the market shaken out here. But I think the move in the coming weeks and months is really higher as managers just panic in and have to lever up to catch their benchmarks. Earnings are good. Earnings are coming in better than expected. And this chart here from LPL, I think it was Ryan Dietrich on LinkedIn put this out. It shows the S&P index returns after 325 basis point cuts, which we just had. The average 1 month return 2.2%, 3 month return 7.9%, 6 month return 10.1%, and 12 month 20%. All of the kind of fears of the market, which we covered last week in this article, the Kenny Chesney everything's going to be all right market. We addressed some of the bear concerns of negative earnings growth. We just went over that. Low GDP estimates. We just got those numbers in. We're looking okay. Global manufacture slowing. We heard all week these numbers seem to be troughing, which is constructive sign. We'll see if that follows through. The trade wars seem to be getting resolved. We'll get a phase one. And one of the points we made in the Three Tenors article is Trump really played chicken with Powell this year. I mean, he held this China deal out as uncertainty, and we needed the cuts, and he got the 3 cuts. And I think both he knows, the administration knows, and the market knows there's not more behind it. We got our adjustment. We got a reversal on the errors that were made in December and in October of 2008 with tightening into slowing growth and cutting off liquidity. They've stopped the quantitative tightening. They've expanded the balance sheet. So the Fed's now done everything they could to reverse the over-tightening and wrong-footedness of their behavior at the end of last year. And now they've really set the table for good things to happen. And it's really back in Trump's court. And he knows he's got to get this done. I think the phase one will get done without a major hitch. And the market will like that. And that will enable industrial companies to start to take estimates up, or at least stabilize estimates near that double-digit growth. And you've got a discount rate now that's come down 75 basis points, which affords mid to late cycle multiple expansion. It's natural at the end of cycle for those people who think we're at the end of the cycle. I think we've now probably got another year and a half plus, maybe more, to have a 19 to 21 times forward multiple. And we're just hovering around the 5-year average here at 17 times. So there's plenty of room for multiple expansion. There's room for earning surprises to the upside. And there are a lot of sectors that haven't yet participated that you'll see the money rotate into and help take the overall market up. So things look very, very constructive here. As far as impeachment, when the impeachment inquiry started in October 6th in the House of 1998, the S&P rose over 50% over the next 18 months. So impeachment is actually bullish, unless you have an oil shock like you had in 73 with Nixon, and we have nothing like that at present. So on balance, if there's an impeachment in the House, it's a non-issue. It won't get through to the Senate. It probably won't even get done in the House, but that really doesn't matter. It's we're talking about the market here. And other than that, just wanted to cover one last thing this week on how earnings are coming in. Let's see here, make sure we covered everything. Oh, the other issue was that one of the arguments that the bears tend to make, and the bears will have their day in the sun. Don't get me wrong. I'm not bullish or bearish. I happen to be looking at the facts and think we've got a good year or so ahead. But 10-year expansions are not the exception. I know that's been kind of the chronic narrative on financial news and so on. But the exception are these short expansions that we've had just in the last 15 years to, rally for 5 years and then crash and rally and then crash. That's the exception. What's natural is we cover in this article here that I wrote in July, which has started to get a lot of traffic the last couple of weeks. No one's writing about this perspective. What's natural is to have, after these long periods of consolidation where you do nothing, when you break out, this is from 1953 when we broke out to 1968, 15 plus year expansions. Here we broke out 1982 to 2000, 18-year expansions. We only broke out in 2013, which, the implication is you could have another, 15, into the 2030s before you see any material situation where you'd have to consolidate for a long period of time. Now, that doesn't preclude the possibility of a 1987 move where you have a 20-30% correction and you keep going. All those are on the table, or the early 60s here. That was all part of a longer-term bull move. But, we've kind of paid our dues here, just as we did in the 70s, and then we got a long move, and as they did in the 30s and 40s, here in the late 60s to the early 80s, and for about 13 years in the 2000s before we finally broke out. So there is opportunity, and that's really all I wanted to recap for this week. Earnings improvement. Just 2 weeks ago, we had negative 4.8% earnings expectations for Q3. We picked up 110 basis points last week. I wrote about this yesterday on Friday. We picked up another 100 basis points this week. So now we're looking at negative 2.7% for this quarter, much better than expected, with 29% left of the S&P 500 to report. So even if you pick up 100 to 160 more basis points of improvement, the average per quarter is about 3.7% improvement. You're still at negative, and as we covered, that's not necessarily a bad thing, unless you're looking in the rearview mirror, which doesn't help you with forward expectations, still near 10% growth going forward, and the first period of growth since 2016 to 2017. So that's really it. Market positioning, you saw the Bank of America Merrill Lynch article reference the Global Fund Managers Survey. I'll be very eager to see that in the coming week and a half, and see how managers started to position themselves in and how they're thinking about things here in early November. That's a very important report that's put out. But looking at the NAAIM, which we covered, they're underweight, so they're going to have to chase into the end of the year. Maybe we'll get a couple mini shakeouts with the short-term sentiment, up here on the fear and greed. It could still run further. On the AAII, it's got plenty of room. I mean, this thing's run as high as 60, mid 40s, etc. And if you go further back, it's up here is not abnormal. So on balance, intermediate term bullish, short term bullish to mix. Maybe you get a little short term pullback, but you're going to need exposure into year end. Managers are going to need to get that exposure to take advantage. And on balance, things look good. So thanks for listening in, and we'll catch you next week.